Howdy, everybody. Welcome to the Liberty Call for Thursday, March 3rd, 2022. Hope everybody's having a great Thursday out there. It's a beautiful day here in Colorado. Clear skies, lots of sun. Let's see, it's 58 degrees here. But hey, we have some cold weather coming again. We got 3 days of snow coming over the weekend. So yay! And I think a little more end of next week. So we're not out of the woods here in the mountains, but hopefully everyone else out there in the interwebs is having a fantastic day. If it's your first time watching, please hit the subscribe button and like and share with friends and family. Let's go ahead and dive in and take a look and see how the markets did today. It's kind of a back and forth day with the markets. They started out down, went into positive territory, and then finished up the day in the red. The Dow Jones finished down 0.29%, closing at 33,794. S&P was down 0.53%, closing at 4363. NASDAQ down 1.56%, closing at 13,537. Small caps are down 1.5% also. The VIX was down 0.85, closing at 30.48. All right, so that's the domestics. Getting into internationals, mostly red. See, the Mexico exchange was in the positive. What is this? Austria was in the positive, but everything between those two was down 2-3%. In Western Europe, getting over to Eastern Europe, red, red, red. The Russian markets closed again since last Friday. See, the first green I see here is Hungary and Turkey. They had up markets. Let's see here, getting into the Asian markets, they were kind of mixed. It looks like Australia and New Zealand had positive days. Same with Japan and Saudi Arabia. But you get into the Chinese markets, the Shanghai, the SCSE, the China A50, and the DJ Shanghai, they were all down, and the Hang Seng was up. So kind of a mixed day across Asia. Eastern and Western Europe, not the best. And then, like I said, we finished off the day anywhere from about 0.25% down to about 1.5% on the major indexes. So not a great day, but again, with what's going on in the world with Russia, Ukraine, we have our own problems here domestically with inflation, overspending, government run by retards. So, it's a mess. What we can really hope for is that, this all falls apart and that we get to rebuild with smarter people in charge. So that's my hope. All right, so let's go ahead and read this market recap. S&P 500 struggles for direction as Ukraine crisis, inflation jitters way. It's written by Yassine Ibrahim. Fix the text here. All right. The S&P 500 struggled for direction Thursday as investors piled into defensive sectors of the market amid ongoing concern Russia's invasion of Ukraine will add to the red-hot pace of inflation that could hurt the economy. Utilities, a defensive corner of the market, was the biggest sector gainer as investors mulled the prospect of further inflation pressures following Russia's invasion of Ukraine as prices for oil, wheat, and precious metals trend higher. The 5-year break-even rate on Treasury inflation-protected securities, a closely watched gauge of inflation expectations, jumped 3.23%, a record high. U.S. oil prices briefly rose to $116 a barrel intraday, pushing gas prices above $5 a gallon in some parts of the U.S., I'd guess California. In testimony on Thursday, Powell said inflation, the upward pressure on inflation was expected to continue for at least a while and flagged the risk that the Ukraine crisis will prolong supply chain problems, which have been a key driver of inflation. So we need to proofread these articles. It's not going to happen at all with supply chains because ships are not being offloaded, Powell said in testimony before the Senate on Thursday. There was some progress on the Ukraine-Russia talks. Meanwhile, as both sides agreed to organize safe passage to evacuate civilians and to deliver humanitarian supplies, French President Emmanuel Macron reportedly warned, however, that the worst is still to come in Ukraine as Putin is hell-bent on taking full control through either diplomatic or military measures. Yeah, he wants to blow up the country, I think. Tech stocks struggled to add to their gains from a day earlier. Big tech mostly lower, while semiconductor heavyweights like Nvidia, Advanced Micro Devices, and Intel also weighed on the sector. Intel fell more than 1% after Morgan Stanley downgraded the stock to underweight from equal weight and cut the price target to $47 from $55, citing more actionable opportunities elsewhere. While the longer-term turnaround capability in Intel's core business is a positive, the next couple of years are likely to see the stock move sideways, and we see more actionable opportunities elsewhere in our coverage, Morgan Stanley said. Snowflake slumped 18% after reporting fourth quarter results that beat Wall Street estimates, but guidance fell short, stoking concerns of slowing growth ahead. Best Buy jumped more than 9%, despite quarterly revenue and full-year guidance below analyst estimates. Kroger surged 10% after reporting earnings per share of 91 cents and key revenue of $33.1 billion that beat estimates of 0.74 cents and $32.9 billion, respectively, while guidance was also stronger than expected. So, kind of like I said, kind of a mixed day. People are kind of, I think, sitting around waiting to see where things go. I think a lot of folks are waiting, at least in my position, waiting to see what the Fed's going to do at their meeting. What day is that going to be on? 15th and 16th are, what is that about? 2 weeks from Tuesday and Wednesday. So it'd be interesting to see what happens. With that. But, like I said, all in all, kind of a bleh day in the markets. So, all right, well, let's take a look at this next one here. U.S. weekly jobless claims fall. Service industry activity slows further. It's written by Lucia Muticani from Reuters. The number of Americans filing new claims for unemployment benefits dropped to their lowest level this week. Lowest level this year last week, while layoffs declined sharply in February, indicating that the labor market recovery was gaining steam. But the upbeat labor market outlook was overshadowed by a survey on Thursday showing service industry activity slowed for a third straight month in February, with a measure of employment in the sector contracting for the first time since June of 2021. According to the ISM, services businesses reported they were having significant issues with hiring both full-time and contract labor, and open positions are not being filled, and candidates are looking for more money. Employment growth at factories also slowed last month, which poses a downside risk to job gains in February. There were near a record 10.9 million job openings at the end of December. Economists are expecting the government's closely watched employment report on Friday will show another month of solid job growth, with the Omicron COVID-19 variant wave of infection significantly diminished. Workers leaving for better paying jobs and more flexible conditions are annoying for employers, but the churn is neutral for employment on net as long as the workers find a job that satisfies their needs, said Will Cumbernoll, a senior economist at FHN Financial in New York. The contraction is not encouraging, but lingering Omicron effects have spilled into February. Let me stop there. Where? No one's sick. Looking at the numbers for Colorado, I think there were like 300 people in the hospital when I checked yesterday. So, come on. It's just, to use that as an excuse, it's the same as using inflation. The inflation problem that we're dealing with is due to the Russia-Ukraine issue and supply chains and oil prices. It's using whatever the current problem is to blame you as blame for all your problems. Initial claims for state unemployment benefits dropped 18,000 to a seasonally adjusted 215 for the week ended February 26th, the lowest level since January 1, and the second straight weekly drop. The Labor Department said economists polled by Reuters had forecasted 225,000 applications. Unadjusted claims declined 21,285 to 194,693 last week, led by big decreases in California and Michigan, which offset a jump in filings in Massachusetts and Rhode Island. Claims could soon fall back below 200,000, a level where last below in early December. Claims have plunged from a record 6.149 million in early April 2020, The number of people receiving benefits after the initial week of aid edged up 2,000 to 1.476 million during the week ended February 19th. Tight labor market conditions are fueling wage growth, which is adding to inflation pressures. Federal Reserve Chairman Jerome Powell told lawmakers on Wednesday that the labor market is extremely tight. I guess he's out there, going to every Arby's and McDonald's, seeing how many people are looking for jobs or how many employers are looking for workers. Powell said he would support a 25 basis point interest rate hike at the U.S. Central Bank's March 15-16 policy meeting and would be prepared to move more aggressively if inflation does not abate as fast as expected. Stocks on Wall Street were mostly higher. The dollar rose against a basket of currencies. U.S. Treasury yields fell. The ISM said on Thursday its non-manufacturing index fell to 56.5 in February, the lowest in a year, from 59.9 in January. The third straight monthly decline in the index was despite coronavirus cases decreasing substantially from mid-January. A reading above 50 indicates growth in the services sector, which accounts for more than two-thirds of the U.S. economic activity. The bulk of the survey was likely conducted before Russia started its war against Ukraine last week, which has boosted prices of oil, wheat, and other commodities. The ISM said supply chain disruptions, capacity constraints, inflation, logistical challenges, and labor shortages were affecting services businesses' ability to meet demand, leading to a cooling in business activity and economic growth. Inflation and supply constraints could worsen because of the Russia-Ukraine conflict. Sure. Though Europe will bear the brunt of the economic costs of the Russia-Ukraine crisis, unfavorable geopolitics in the continent threaten to exacerbate supply issues and price pressures for the U.S. services sector, said Bernard Yaros, an economist at Moody's Analytics in Westchester, Pennsylvania. There will be disruptions to the transportation and logistics industries. Many flights have been canceled or rerouted, leading to increased pressure on cargo capacity. The services industry employment gauge dropped to a 1.5-year low of 48.5 from 52.3 in January. It was the first contraction in the index since June of 2021. Some companies in the professional, scientific, and technical services industry declared that the Great Resignation was real. Economists at Wells Fargo lowered their February payroll forecast to 375,000 from 450,000 earlier. According to Reuters' survey of economists, non-farm payrolls likely increased by 400,000 jobs in January after rising 467,000 in January. The employment rate is forecast to fall to 3.9 from 4.0 in January. Hopes for solid employment report were supported by a third report from global outplacement firm Challenger Gray and Christmas, showing U.S.-based employers announced 15,245 job cuts in February, down 20% from January. Companies also announced plans to hire 215,127 workers last month, the largest February total since Challenger began tracking monthly hiring figures in 2002. That compared to the 77,630 jobs announced in January. So, again, kind of a mixed bag. The employment numbers look pretty good from a filing for unemployment and collecting benefits, but there are still, 10,000 or nearly, almost 11 million jobs out there that are open. So, I'd like to see that number come down. I'd also like to see the number of employed Americans above where we were 2 years ago when all this madness started. But again, that's going to be a slow climb. And when you have a lot of people who want to get paid a lot of money for not doing a whole lot, it's going to be a tough road ahead of them. All right, I got two articles that have to do with currencies and the dollar. So go ahead and breeze through these in real quick. First one is if Russian currency reserves aren't real money, the world is in for a shock. It's written by John Sindrew. All right. What is money is a question that economists have pondered for centuries, but the blocking of Russia's central bank reserves has revived its relevance for the world's biggest nations, particularly China, in a world in which accumulating foreign assets is seen as risky. Military and economic blocks are set to drift further apart. After Moscow attacked Ukraine last week, the U.S. and its allies shut off the Russian central bank's access to most of its $630 billion of foreign reserves. Weaponizing the monetary system against a group of 20 countries will have lasting repercussions. The 1997 Asian financial crisis scared developing countries into accumulating more funds to shield their currencies from crashes, pushing official reserves from less than 2 trillion to a record 14.9 trillion in 2021. According to the International Monetary Fund, uh, while central banks have lately sought to buy and repatriate gold, it only makes up 13% of their assets. Foreign currencies are 78%. The rest is positions at the IMF and special drawing rights, or SDRs, an IMF created claim on hard currencies. Many economists have long equated this money to savings in a piggy bank, which in turn correspond to investments made abroad in the real economy. Recent events highlighted the error in this thinking. Barrick Gold, these assets are someone else's liability, someone who can just decide they are worth nothing. Last year, the IMF suspended Taliban controlled Afghanistan's access to funds and SDR. Sanctions on Iran have confirmed that holding reserves offshore doesn't stop the U.S. Treasury from taking action. As New England law professor Christine Abley points out, the 2017 settlement with Singapore CSE Transtel shows that the mere use of the dollar abroad can violate sanctions on the premise that some payment clearing ultimately happens on U.S. soil. To be sure, the West has frozen Russia's stock of foreign exchange, but hasn't blocked the inflow of new dollars and euros. The country's current account surplus is estimated at $20 billion a month due to exports of oil and gas, which the U.S. and European Union want to keep buying. While these balances go to the private sector, officials have mobilized them, stopping major banks like Sberbank from using dollars and excluding others from using Swift messaging. The Swift messaging system still plunges the economy into chaos, especially if foreign businesses are afraid of buying Russian energy despite the sector's explicit exclusion from sanctions. But hard currency will probably keep gushing in through energy-focused lenders like Gazprom Bank, and can theoretically be used to pay for imports and buy the ruble. Yet the entire artifice of money as a universal store of value risks being eroded by banning key exports to Russia and boycotts of the kind corporations like Apple and Nike announced this week. If currency balances were to become worthless computer entries and didn't guarantee buying essential stuff, Moscow would be rational to stop accumulating them and stockpile physical wealth in oil barrels rather than to sell them to the West. At the very least, more of Russia's money will likely shift into gold and Chinese assets. Indeed, the case levied against Chinese attempts to internationalize the renminbi has been that, unlike the dollar, access to it has always been risky, or is always at risk of being revoked by political considerations. It is now apparent that, to a point, this is true of all currencies. The risk to king dollar status is still limited due to most nations' alignment with the West and Beijing's capital controls, but the financial and economic linkages between China and sanctioned countries are that are only allowed to accumulate reserves and, crucially, spend them will necessarily strengthen. Even nations that aren't sanctioned may want to diversify their geopolitical risk. It seems to further the deglobalization trend and entrench two separate spheres of technological, monetary, and military power. China itself owns 3.3 trillion in currency reserves. Unlike Russia, it cannot hold them in renminbi, a currency it prints. Stockpiling commodities is an alternative. The conundrum creates another incentive for Beijing to reduce its trade surplus by reorienting its economy towards domestic consumption, though it has proven challenging. What can investors do? For once, the old trope may not be ill-advised. Buy gold. Many of the world's central banks will surely be doing it. So, and I think the point of this is, simply to say that, if one country or one group can simply say, hey, we're turning off your access to your own money, that could certainly lead to bigger problems, world wars, things like that. I don't think the dollar's in any real place to be pushing other people around, especially as, what's the word I want to use is, I guess, just the dangerous position it's in with the amount of debt, the amount of printing. I could certainly see in the next 5 to 10 years that the dollar could crash, and we're using something else in the future. All right. Last one, Russia, Ukraine, the end of the dollar dominance. Don't bet on it. Written by Javier E. David. All right. Is the US dollar over as a reserve currency? That is one of several takeaways from the increasingly and fractious conflict between Russia and Ukraine. A flurry of heavy handed sanctions has isolated Moscow and yet ricocheted across the global economy in unexpected ways, not the least of which includes inflation spurred by skyrocketing energy prices and fears surrounding Russian supply. The debate over the morality and feasibility of blockading Russia has amplified another debate that's brewed for years, namely, can the greenback maintain its superiority over other currencies as the reserve instrument of choice? Some think that the international community's response to Moscow may light the fuse that makes other countries finally dump the dollar for good, as Russia itself has done for years, since its aggressive behavior caused governments to put the squeeze on its finances. That suggestion was reinforced on Wednesday by Fed Chairman Jerome Powell, who raised eyebrows by floating that it was possible to have more than one reserve currency. Speaking to Bloomberg News, Joe Weisenthal and Tracy Alloway this week, investor Zoltan Poznar warned that Russia's loss of access to its reserves has sent the message that institutions can't count on dollars if geopolitical issues arise, making the dollar less attractive as a safe haven. And Dylan Grice, founder of Calderwood Capital, warned this week that the sanctions squeeze represented a turning point in monetary history, the end of the dollar hegemony, the acceleration towards a bipolar monetary order. At well over $600 billion, Russia sits on one of the world's largest currency and gold reserves, but that money is now fairly useless in the face of tough sanctions that are foreclosing the ability of the country's institutions to conduct transactions. So is the dollar's demise really as imminent as it seems? Not quite, and maybe not at all. It bears repeating that the number of global crises and the number of U.S.-owned fiscal baggage have yet to knock the greenback off its perch. China, one of the single biggest holders of dollar-denominated assets, was once thought to be primed to sell them in the wake of former President Donald Trump's trade war with Beijing. That never happened, and there were a few solid reasons why. I don't buy it, said Mark Chandler of Bannockburn Global Forex when asked by the Morning Brief whether the Russia-Ukraine crisis would lead to a wholesale abandonment of the dollar. It's the same problem as always, no clear, compelling alternative, he said in an email. Moreover, the Europeans have also sanctioned Russia's central bank so that the alternative could not be the euro, he added. Cryptocurrencies are currently seen as the most feasible or at least proximate alternative in recent days. Digital tokens have seen strong demand despite risk aversion, raising speculation that Russians and Ukrainians are both migrating to crypto given the constraints placed on them by sanctions. Yet in a research note Wednesday, Citigroup downplayed the impact of Russia flows, suggesting the bid in crypto was mostly speculative. Bannockburn Chandler was also skeptical of the idea that the crypto could eventually supplant the dollar, even in the near term. Crypto to replace the role of treasuries that stand behind the dollar, nowhere close. The analyst said, to move out of treasuries is to give up yield, liquidity, transparency, and security for exactly what? Given the unanimity of international consensus against Russian President Vladimir Putin, it seems unlikely that any major economy would opt out of the global financial system that's predicated on dollar dominance, at least for the moment. Putin has done what several American presidents have failed to do: reinvigorate NATO, boost German defense spending, and get multinational companies around the world to participate in sanctions, Chandler pointed out. Pax Americana seemed to be stronger post-Russian invasion of Ukraine. Even Chinese banks continue to adhere to U.S. sanctions, and there seems to be greater space between Russia and China than before, he added. One option on the table is that the central banking digital currency, the Fed's incipient moves towards creating the CBDC is unlikely to happen for quite a while. Back in January, Yahoo Finance's Jennifer Schoenberger reported that the Fed sees a CBDC as one way to help preserve the dollar's traditional role as a reserve currency of choice rather than undermine it. The Fed's incremental moves towards a digital dollar are in part why Bitcoin investor Anthony Pompliano wrote last week that America has to start considering what to do in a world where a larger portion of the world doesn't use the US dollar as their reserve currency. Given the widening divergence between the US, China, and Russia, the latter two may well decide that the cost of using the global currency reserve or the current global reserve currency has become too high. They are unlikely to use rubles or renminbis as a new reserve currency. There isn't enough global buy-in, along with the general challenge of convincing the world that these two new states won't repeat the mistakes of past nation states, Pompliano wrote. Suggesting Bitcoin is the next best option, he listed a few ways that the U.S. could incentivize its use. He suggested monetary authorities could start adding it to their books like any other reserve asset and treat it like a traditional currency. Yes, the use cases of and appeal of cryptocurrency are certainly growing, but the sector is not nearly stable or established enough to touch dollar-denominated treasuries, which every central bank and institutional investor in the world still wants, even with all the U.S. debt and deficit spending. I agree that the U.S. treasuries are, I don't want to say the most. Well, I guess they are the most in demand. I guess right now we still have the hopes that we're going to get repaid in dollars, but at some point, the debt's going to get too big, and the dollar's going to lose a lot of the steam that it had. And when it falls apart, all I know is I don't want to be the one holding them. So, all right, well, that's everything I had for today. Hope everyone has a fantastic Thursday evening. And I think the Cougs are on again this evening. So another Cougar game for me. Yay. Not so happy for my wife. Well, she sits there and watches it, but I know it's not her favorite. But all right. Well, like I said, hope everybody has a great night. And I'll be back tomorrow with the wrap up for the week. And everyone have a great evening. Bye-bye.